There are only two companies standing between global trade and total collapse, and almost no one knows their names. Every day, over 90% of global trade moves by sea. Oil, food, cars, electronics, everything you use depends on ships crossing oceans non-stop. But here's the problem. Every one of those ships carries massive risk. Collisions, fires, piracy, storms, even total loss at sea. A single accident can cost billions. So who takes that risk? Not governments, not the shipping companies themselves. It comes down to a system so concentrated that just two major players quietly control almost all global ship insurance. And if they fail, global trade doesn't slow down, it stops. To understand how dangerous that is, you need to see how this system actually works. Ship insurance isn't simple coverage like your car or house. It's split into layers, each covering different types of disasters. The most important layer is something called Protection and Indemnity, or P&I. This is the insurance that covers the worst-case scenarios: oil spills, environmental disasters, crew injuries, cargo loss, even wreck removal. These costs can reach tens of billions from a single incident. Most of this insurance doesn't come from normal insurance companies. It comes from mutual groups called P&I clubs. These are organizations where ship owners pool risk together. Now here's the critical part. Almost all major P&I clubs are tied together under one system, known as the International Group. And within that system, risk doesn't stay local. It gets shared globally. If one ship causes a massive disaster, the cost gets spread across the entire network. That sounds stable until you realize who actually backs that network. Because when losses get too big, the P&I clubs don't pay alone. They pass the risk to reinsurance companies. And this is where control collapses into just two names. The global reinsurance market is dominated by a handful of giants. But in marine insurance, two companies stand above the rest. They quietly absorb massive portions of the risk that keeps global shipping alive. Companies like Munich Re and Swiss Re don't just insure ships, they insure the insurers. That means when a catastrophic event happens, these companies are the final line of defense. If they refuse coverage, raise prices, or pull out, the entire system starts to crack. Now imagine this scenario. A massive oil tanker spills millions of barrels into a critical shipping lane. Cleanup costs explode past $20 billion. Multiple claims hit at once. The P&I clubs pass the damage upward, and suddenly those two reinsurers are responsible for covering losses that ripple across the entire planet. If they hesitate, everything changes. Shipping companies can't operate without insurance. Ports won't accept uninsured vessels. Governments block entry. Trade halts instantly. No insurance means no movement. This system is already under pressure. Climate change is increasing storm intensity. Piracy is rising in key choke points. Ships are getting larger, meaning accidents are more expensive than ever. The risks are growing faster than the system designed to absorb them. So insurers respond the only way they can. They raise premiums, they tighten coverage, they become more selective. That might sound normal, but in shipping, it creates a dangerous chain reaction. When insurance becomes too expensive, smaller shipping companies get pushed out. Only the largest players can afford coverage. This concentrates power even further. Now fewer companies control more ships, more cargo, and more global trade. And all of it still depends on the same fragile insurance backbone. But there's another layer most people never see: sanctions. Global politics directly impact ship insurance. If a country gets sanctioned, ships linked to that country can lose access to insurance overnight. That means they can't legally operate in most ports. This has already happened. Entire fleets have effectively been shut out of global trade, not because they physically couldn't sail, but because they couldn't get insured. Insurance becomes a weapon. Now imagine those same reinsurers deciding certain regions are too risky: war zones, conflict areas, politically unstable regions. If they pull coverage, entire trade routes disappear. Oil doesn't move, goods get stranded, prices surge worldwide. And this isn't hypothetical. During major conflicts, insurance rates for certain routes spike dramatically. Sometimes ships avoid those areas completely. Trade reshapes itself overnight, all because a few companies decide the risk is too high.